The silence means nothing. Markets are dark. Tickers frozen. Silver locked at $71.47. It looks calm. It isn't. Beneath the surface, pressure is compounding to levels the system has never absorbed. We're inside the eye. In 6 hours, 6 p.m. Eastern, electronic futures rip open. Capital that's been caged for 2 weeks floods the room at once. This isn't a trading day starting. This is a trading year detonating. The first week of January is the most violent stretch in institutional finance. It's called the January effect, a mechanical event where hundreds of billions in pension money, insurance reserves, and hedge fund capital are forced into rebalancing positions. This year, their models are screaming on word: silver, the best performing asset of 2025. But there's a problem. There is no silver. Vaults are hollow. Dealers are tapped. Miners are holding. When that $50 billion wave hits tonight, it slams into a scarcity wall. We're preparing you for the opening bell of 2026. You'll see the mechanics of the pension panic. You'll understand why the banks that crushed price on New Year's Eve are about to flip and chase it higher. And you'll get the battle plan for the next 48 hours. The countdown is live. The capital is queued. The price is about to break. This is the January squeeze. To understand why tonight matters, you need to understand Wall Street's plumbing. Retail trades on emotion. They buy excitement, sell fear. Institutions trade on dates. December 31st is fiscal year end. Until midnight, the game was defense. Managers dumping winners to lock bonuses. Banks shedding assets to clean risk scores. Taxpayers harvesting losses. December is pure selling pressure. The moment the calendar turned, the game flipped to offense. Tax year closed. Selling pressure vanished. New allocations activated. Every major fund has a target for the new year. We want 2% commodities. We want 5% gold. Right now, they own 0. They have to move from 0 to 5%. Fast. They executing the first 5 trading days of January. This creates an artificial tsunami of buy demand that has nothing to do with news and everything to do with allocation. A wall of money hits the market. This year, that wall is bigger than it's ever been. Why? Because in 2025, bonds collapsed. Stocks were chaos. Silver was the only thing that worked. So the model portfolios, the programs that tell bankers what to buy, are screaming silver. They are mandated buyers. No choice. And they're about to force elephant-sized orders through the mouse hole of the silver futures market. Let's scale this. Global pension and endowment assets, $50 trillion. Historically, they ignored commodities. But inflation is sticking above 5%. They're panicking. Money is fleeing the 60/40 stock bond split into alternatives. If the global pension system moves just 0.1% into silver, that's $50 billion. Now look at the silver market. Total annual mine production globally, 800 million ounces. At $71, that's worth $56 billion. See the math problem? Pension funds want to buy nearly the entire annual planetary supply in the first week of January. It doesn't fit. You can't buy $50 billion of silver at $71. There isn't enough metal. So what happens? Price becomes the rationing mechanism. Price has to rise until that $50 billion buys less metal. If silver hits $140, that money only buys half the annual supply. If it hits $280, it buys a quarter. Price must rise to accommodate the capital. This isn't speculation. This is fluid dynamics. When you pour a gallon into a shot glass, it overflows. Tonight, the water starts pouring. The first surge hits tonight. Thursday, 6 p.m. New York time. Globex electronic markets open. This is where algos trade while floor traders sleep. Holiday sessions are usually dead. Tonight is different. Asian arbitrage is still wide open. While New York was closed, Shanghai stayed hungry. The gap between U.S. price and China price is still live. Tonight, arbitrage bots activate. They see the gap. They see cheap silver in New York. They hit buy. This could trigger a gap up at the open. Silver could jump from $71.47 to $73 in the first minute. If that happens, it sets the tone for Friday. It tells human traders the dip is finished. Buying has started. It creates urgency. Anyone waiting for lower prices realizes they missed the bottom. They panic buy. Fear of missing out adds fuel to the fire the algo's already lit. Now let's talk about the banks. Yesterday they were forced to sell silver to sanitize balance sheets for year-end snapshots. They crushed price to $70.50. They hit their target. They lowered their risk score. They saved their bonuses. But the snapshot is over. Regulators took the picture and left the room. Banks are free to trade again. And what do banks do? They trade to make money. They know the flow is coming. They know pension funds are buying Friday. So do you think the banks stay short? No. They front-run their own clients. JPMorgan knows California teachers' pension is buying silver tomorrow. So JPMorgan buys tonight. They buy at $72, sell to the teachers at $75. They scalp the move. This means the banks, the biggest sellers of 2025, will likely be the biggest buyers in the first 48 hours of 2026. They're flipping the switch. The suppressor becomes the squeezer. They want to ride the wave up before they short it later. This aligns every major force in the market. East is buying. Pension funds are buying. Banks are buying. Who's selling? Nobody. Miners are holding. Dealers are out. Retail is hodling. This is the recipe for vertical. Paper money is lining up. But what about the metal? While markets were closed, the physical shortage didn't take a holiday. Factories in China still running. Mines in Mexico still depleting. We need to examine the physical disconnect entering the new year. We're checking dealer premiums one last time before the open. And we're explaining why street price of silver will likely cross $100 in January regardless of what COMEX does. The countdown is ticking. We are hours from the first trade of 2026. If you're looking at the chart, you see $71.47. That number is flashing on screens in Tokyo, London, New York. It's the number algos use to value billions in derivatives. But here's what the bankers won't admit. That price is a lie. It's a phantom price. The price of a digital contract traded on a holiday week with thin volume. If you try to take $71.47 into the real world and exchange it for an ounce of physical silver, you'll be laughed out. The paper market is living in fantasy. The physical market is living in supply crisis. We're exposing the massive disconnect between screen and street. We're showing what happened to bullion dealers in the last 48 hours. We're explaining why premiums on physical silver have exploded to historic highs even as spot price dipped. And we're revealing why industrial buyers, companies that actually consume the metal, are already paying $80 per ounce in private deals just to secure January delivery. The paper market is about to open, but the physical market never closed. And it's screaming shortage. Let's talk about Main Street this week. While hedge funds sold paper to lower taxes, the retail public stormed coin shops. Reports from major online bullion dealers in the U.S. and Europe. Complete inventory blowout. The week between Christmas and New Year is usually quiet. This year, sales volume was up 300% versus last year. Because the public smells fear. They saw volatility. They saw dead headlines. They saw the crash and recovery. They decided to take possession. But here's the problem. Dealers can't restock. Sovereign mints, U.S. Mint, Royal Canadian Mint are closed for holidays. Wholesalers running skeleton crews. Every ounce spot this week is an ounce that can't be replaced until mid-January. Shelves are bare. So what did dealers do? Lower price to match the spot drop? No, they raised it. The premium on a Silver Eagle right now is approaching $20 over spot. Ask price is over $90. This is the market telling you truth. Spot price says silver is abundant. Premium says silver is extinct. This divergence is the most reliable signal in commodities. When paper drops but physical rises, it means the paper market is broken. It means shorts are suppressing a beach ball fighting to surface. When the paper market finally snaps, it gaps up to meet physical price. It doesn't meet in the middle. It gaps. Now look at the whales of the physical world, industrial users. There's a January effect for industry too. It's called procurement season. In January, companies like Samsung, Tesla, First Solar negotiate annual supply contracts. They sit with refiners and miners to lock price and volume for the year. Usually it's boring. We need 10 tons. Here's the price. This year, it's a panic room. Refiners are telling industrial giants, we don't have enough metal. Mines are depleting. Chinese are hoarding. Recycling is failing. We can only give you 70% of what you need. Imagine you're CEO of a solar company. You have a mandate to double production in 2026. Your supplier tells you they're cutting your silver allocation by 30%. What do? You panic. You hit the spot market. You buy everything not nailed down. $75? Fine. $80? Fine. You need metal to keep the factory open. This is happening right now. While markets are closed, procurement teams are making calls. Off-market transactions. Buying silver directly from vaults in London and Zurich. Bypassing COMEX. This removes visible inventory from the exchange. When COMEX opens tomorrow, traders look at warehouse reports and ask, where did the silver go? It went to a solar farm in Arizona. It's never coming back. We can't discuss physical silver without China. While New York sleeps, Shanghai eats. Price in China is still trading at massive premium to the West. We're looking at a gap near $5. While New York slept, China implemented new silver export controls today, January 1st. They're locking doors while Wall Street is still finding the keys. This arbitrage is the engine of the shortage. Every day New York trades lower than Shanghai. A fleet of planes takes off from JFK and Heathrow carrying silver bars east. This isn't conspiracy. It's math. If you can buy an iPhone for $500 in New York and sell for $600 in Shanghai, you buy every iPhone in New York. That's what's happening to silver bars. The West is being drained of strategic reserve. We're selling heritage for paper dollars. China is happily taking it. They know in 2026 the paper game ends. They want to hold physical chips when the music stops. This flow creates a floor under price. Price can't drop below the level where arbitrage becomes profitable. Right now that floor is $71. If silver drops below $71, Chinese buyers back up the truck. They act as buyer of last resort. This limits downside risk. You're investing alongside a superpower cornering the market. Skeptics say if price is $70, miners will just dig more. No, they won't. This is the supply cliff. It takes 10 years to open a new mine. Even at $100 per ounce, you can't speed geology. You can't speed permits. You can't speed construction. Supply might actually drop in 2026. Why? Political risk. Look at Mexico. Look at Peru. Governments see $70 silver and get greedy. They're talking higher taxes. Nationalization. When governments attack miners, miners stop investing. They stop digging. They strike. Precisely when the world needs more silver, the political environment ensures we get less. This is structural deficit. It's not fixable by price alone. It requires a decade of investment and stability. We have neither. Industrial buyers know no help is coming from mines. Retail buyers know no help is coming from mints. The only place to get silver is existing stockpiles. The vaults. The vaults are running on fumes. Physical market is tight. Dealers empty. Industry panicking. But there's a bigger storm on the horizon. A storm that will make supply shortage look like minor inconvenience. The macro economy. We're zooming out. We're examining the debt ceiling crisis scheduled to hit Washington in February, the bond market revolt, and we're explaining why the Federal Reserve will be forced to print trillions in 2026 just to keep government solvent. Silver isn't just reacting to metal shortage. It's reacting to surplus of fiat currency. We're entering the monetary phase of the bull market. Silver stops trading like a commodity, starts trading like a currency. The physical squeeze lights the fuse. The monetary crisis is the dynamite. We're looking at the death of the dollar. We've spent the last hour on microscopic details. We counted ounces in vaults. We tracked planes to Shanghai. We analyzed solar panels. But if you focus only on metal, you miss the monster. Silver doesn't exist in a vacuum. It exists in a world drowning in $36 trillion of U.S. debt. It exists in a world where the bond market is rebelling against central banks. It exists in a world where full faith and credit of the empire is being questioned for the first time in 80 years. We're zooming out. We're examining the macro storm about to make landfall in Q1 2026. We're explaining why the upcoming debt ceiling crisis in Washington is the trigger that sends commodities into the stratosphere. We're analyzing bond vigilantes driving rates higher, forcing the Fed to print just to keep government solvent. And we're showing you why silver is no longer just industrial metal. It's a currency lifeboat. The physical squeeze lights the fuse. The monetary collapse provides the explosion. Let's look at the debt. While you're celebrating New Year, politicians in Washington are preparing for war. February 2026. United States hits debt ceiling again. We've seen this movie. They fight. They threaten default. They shut down government. Then they raise the limit. But this time is different. This time interest on debt has exploded. U.S. government is now paying over $1 trillion per year just in interest. More than defense budget. More than Medicare. Mathematically unsustainable. When the debt ceiling fight starts next month, the market panics. Credit agencies, Fitch, Moody's, threaten to downgrade U.S. credit rating again. Foreign nations stop buying treasuries. Scared of technical default. This creates crisis of confidence. When investors lose confidence in the risk-free asset, U.S. bonds, where do they go? They go to assets with no counterparty risk. Gold and silver. During the last debt ceiling crisis, gold rallied. This time, with silver already in shortage, the rally amplifies. Silver acts as credit default swap on U.S. government. As probability of government chaos rises, price of silver rises. You're holding insurance against political incompetence. Business is booming. We need to talk about the bond market. Largest market in the world. Controls everything. Right now, the bond market is screaming. Yields rising. Bond vigilantes selling treasuries because they know inflation isn't 2%. They know it's 5% or higher. Why does this matter for silver? Because higher yields break the banking system. We saw it in 2023, Silicon Valley Bank. Banks hold bonds as collateral. When bonds crash, banks become insolvent. If yields spike in January, we see another banking crisis. Another regional bank fails. Maybe a big bank wobbles. What does the Federal Reserve do when banks fail? They pivot. They stop fighting inflation. They stop raising rates. They turn on the money printer. They create emergency liquidity facilities. They flood the system with fresh dollars to save banks. This is the Fed put. Every time the system breaks, they print. Every time they print, dollar value falls. Price of silver rises. We're waiting for the system to break. The bond market is doing the work for us, forcing the Fed into a corner where their only option is inflate away the debt. Inflation is fuel for the silver supercycle. While the West struggles with debt, the East is building a lifeboat. The BRICS alliance, Brazil, Russia, India, China, South Africa, and new members, is actively moving away from the dollar. They call it de-dollarization. In 2026, we expect major announcement regarding a BRICS trade settlement unit, a currency backed not by promises, but by hard assets, gold, oil, rare earths, and silver. China knows to challenge the dollar, they need currency with intrinsic value. Paper money is weapon used by U.S. Commodity money is shield used by BRICS. If silver becomes component of global monetary reserve system, it remonetizes instantly. For 40 years, silver was just a commodity like copper. If it becomes money again, the valuation model changes. Money trades at premium to industrial value. Gold trades at massive premium because it's money. Silver currently trades at industrial value. The monetary premium is the upside. The BRICS nations are the ones who will apply that premium. Wall Street analysts love real interest rates. They say if rates are high, gold and silver should fall because they pay no yield. Textbook theory, but look at reality. Interest rates are 5%. Silver is at $75. The textbook is broken. Why? Because the market knows the interest rate is fake. Real rate is interest minus actual inflation. If the bank pays 5%, but cost of living goes up 10%, your real rate is negative 5%. You're losing purchasing power holding cash. Smart money knows this. They know CPI numbers are cooked. They know true inflation is double digits. So gold and silver are rising with interest rates. This is historic anomaly. It usually only happens during currency collapse, when the market stops believing the central bank rules of economics invert. We're living in that inversion. Finally, the second wave of inflation. Fed claimed victory, said inflation was coming down. But look at the inputs. Oil rising, shipping costs rising, labor costs rising, insurance skyrocketing. Inflation is sticky. In the 1970s, inflation came in 3 waves. First wave hit. Fed raised rates. Inflation fell. Everyone celebrated. Then second wave hit. Bigger. Then third wave. Biggest. We just finished wave 1. Wave 2 is building. When inflation numbers start creeping back up in 2026, market realizes Fed is powerless. They can't raise rates anymore. It would bankrupt U.S. government. So they let inflation run hot. Financial repression. In a world of structural persistent inflation, you need assets that can't be debased. Silver is the ultimate inflation hedge because it's also industrial necessity. It protects you from printing press and benefits from economic growth. Only asset that wins on both sides. The macro storm is gathering. Debt unpayable. Bonds crashing. Inflation returning. Physical silver market empty. What happens when you throw a match into a room filled with dynamite? Explosion. But analysis is useless without execution. The analysis stops. Execution begins. We've reached the final chapter. We dissected the $50 billion wall of capital about to hit the market. We exposed physical dealer blackout and industrial panic. We analyzed the macro superstorm of debt and war. Now analysis stops. Execution begins. Tonight, electronic markets open. Tomorrow morning, the opening bell of 2026 rings. You have the information. You know the why. Now you need the how. We're giving you execution strategy for the first week of January. We're mapping specific price targets we need to hit to confirm the supercycle. We're teaching you the ratio exit so you know when to walk away with your fortune. And we're leaving you with final verdict on the year ahead. The year of potential is over. The year of realization is here. Let's look at the chart one last time before candles start moving. We're sitting at $71.47, resting on massive support. What are targets for first week of January? Target 1, $75. Previous high, Breakout point. If pension funds enter aggressively Friday, we clear $75 within first 48 hours. If we break $75 on high volume, it confirms correction is over. Green light turns on. Target 2, $83. Wick high from Monday squeeze. Technically, price loves to revisit the scene of the crime. Market wants to test that level again to see if sellers are still there. We will challenge $83 before end of January. If we clear $83, we're in blue sky. Target 3, triple digits, quarterly target. If shortage there as real as premiums suggest, and if bond volatility continues, there's no structural resistance between $83 and $100. It's a vacuum. Price could move 80 to 100 faster than it moved 20 to 30. Do not be surprised by parabolic move in Q1. Be prepared. Do not sell into first spike. I need to have a serious conversation with you. Buying is easy. Selling is hard. Most investors ride a bull market all the way up, then ride it all the way down. They fall in love with the asset. Become cultists. You're not a cultist. You're an investor. Goal is to increase purchasing power. So when do you sell? You don't sell for dollars. Dollars are the problem. You sell for gold, land, or income-producing assets. We use gold to silver ratio as GPS. Right now, ratio is roughly 6:0 to 1. Still cheap. Historically, in a bull market, ratio compresses. When ratio hits 4:0 to 1, pay attention. Easy money has been made. When ratio hits 3:0 to 1, start to scale out. Trade 20% of silver for gold. Trading high-risk asset for no-risk asset. Locking in the win. When ratio hits 1:5 to 1, exit completely. Swap all silver for gold. Or buy a farm. Or buy an apartment building. Move from speculation to generational wealth preservation. If you follow this plan, you don't care about dollar price. Don't care if silver is $500 or $5,000. You only care about its value relative to other real assets. Write this ratio down. Tape it to your computer. 1:5 to 1. That's the finish line. We're about to enter a mania. Mania is different from bull market. In bull market, people are optimistic. In mania, people are irrational. You're going to see friends and family, ones who laughed at you, suddenly asking how to buy silver. You're going to see YouTube channels that talk about gaming or makeup suddenly talking precious metals. This is shoeshine boy indicator. When this happens, you'll feel like genius. Your ego will inflate. You'll think you can do no wrong. That's the moment of maximum danger. That's when you'll be tempted to use leverage. Borrow against your house to buy more. Do not do it. When mania hits, your job is to be the adult in the room. Keep your head. Stick to the plan. Don't get greedy at the top. You bought at the bottom. You've already won. Your job now is just to land the plane safely. Also, prepare for volatility. In mania, silver can drop 20% in a day and still be in uptrend. If you're leveraged, you die. If you're physical, you just blink. Stay unleveraged. Stay physical. Stay sane. Here's your checklist for market open tomorrow. 1. Watch Globux open tonight. Does it gap up? If yes, demand is immediate. If it gaps down, it's final trap. 2. Watch volume Friday morning. We want high volume. We want pension funds stepping in. If price rises on low volume, be suspicious. If price rises on massive volume, it's the real deal. 3. Watch the dealers. Do sold out signs disappear or stay up? If dealers still sold out next week, squeeze goes vertical. 4. Watch the media. Are they ignoring it? Good. We're early. Are they screaming? Be careful. We're getting popular. Here's the verdict. 2025 was warm-up. 2026 is main event. We have the perfect storm. Industrial scarcity. Monetary collapse. geopolitical conflict, institutional FOMO. There is no force on earth strong enough to stop this trend. Banks tried. They failed. Governments tried. They failed. Now the market takes over. You've done the work. You've prepared. Now all you do is watch. This is the year you've been waiting for. This is the year silver reclaims its throne. Happy New Year. Keep stacking. I'll see you on the other side of the open.